Hello everyone, welcome to this week's Mortgage Minute. I'm your host, Jason Drobeck with Neo Home Loans. Today, I thought we could take some time to review key differences between conventional and FHA mortgages so you can be better informed when choosing your mortgage strategy. First, let's start with the basics. FHA stands for Federal Housing Administration, and it was the original low down payment option provided for first-time homebuyers. It's got the backing of Ginnie Mae, which is a federal government corporation. Conventional loans, on the flip side, are either sold to Fannie Mae or Freddie Mac, also both of which are government-sponsored entities. There's actually a big debate about whether to pull those out of government sponsorship right now. Let's compare down payments for both products. Now, FHA will allow you to do as little as 3.5% down, while a first-time homebuyer through a conventional loan can do as little as 3% down. And if you're not a first-time homebuyer, you can still do as little as 5% down through a conventional loan. Credit scores. FHA will accommodate a lower credit score and previous bankruptcies and foreclosures more often than a conventional loan will. For instance, the waiting period for a Chapter 7 bankruptcy on an FHA loan is only 2 years, where it's 4 years on conventional. So credit might dictate which mortgage product you need to select. Let's talk about mortgage insurance. Again, mortgage insurance is typically required when you don't have a 20% down payment, and it's something to consider when comparing both of these products as well. FHA's mortgage insurance is not only permanent, so if you make a less than 10% down payment, but you'll also be charged a 1.75% upfront mortgage insurance premium, essentially a buy-in to the FHA program. Conventional mortgage insurance, on the flip side, is not only not permanent, so it automatically drops off once you reach 20% equity in the home, but there's actually ways to avoid the mortgage insurance completely, even with a minimum down payment of 5% or more. A lot of loan officers don't even know this. Another piece to compare are loan limits. So loan limits are universal for conventional loans. You can go to $548,250. This number changes year over year across all counties in the US. And you can go even higher in some high cost areas, such as where I live in Park City, or even a lot of counties across these western states. FHA loan limits are much more conservative, and you won't be able to go as high typically as you can on the conventional side. Now, FHA also tends to be more stringent in its property standards. So the appraiser will vet the property for safety and adherence to local code restrictions, whereas conventional isn't going to be nearly as rigorous. So if you're debating which product to use, FHA or conventional, I would encourage you to reach out to me so we can go over some of these talking points in detail and help you guide you towards the right mortgage strategy. Otherwise, thanks for tuning in. Have a great week, and we'll talk to you guys soon. Bye-bye.